We're working with Chapter 6, and we're going to learn about worksheets for service businesses. These are the things we're going to learn about in this chapter. We're going to learn what a worksheet is and the concepts or terms associated with it. We're going to learn about the practices associated with creating and preparing a worksheet. We're going to learn about what the trial balance is and why that's an important tool in accounting. For instance, my friend Mr. Cronick here, he's going out on his internship yesterday, and his internship guy is going to have him learning a little bit about what a trial balance is. And I said, we're going to learn this in our accounting class tomorrow. And he's going to be working on some reconciliations, helping this company prepare pension fund reconciliations for clients. Pretty cool, okay? And then we're going to learn how to do the adjustments for our companies, prepare complete the rest of the worksheets for a company, and then identify procedures for finding accounting errors and how to correct them. Okay, so first of all, accounting information has to be, as we've learned all year long, organized. You can use it to help you analyze your business. You can use it to summarize financial information and then prepare our financial statement reports. All of these things are essential in order to operate a business and make sure the business is running smoothly, and for investors to know about, managers to know about, banking institutions to know about, taxing authorities to know about. So accounting information helps us to do all of this, and we've been doing all this information all along, entering our journal entries, learning how to post to our ledger. Now we're going to learn how to make this information and put it into a useful format. In accounting, we have another one of those concepts. It's called consistent reporting. And all consistent reporting is it's applying the same sets of procedures and processes time and time and time again. You're going to follow the same ways of doing things. And you want that to be so. You want that to be the case, okay? You want to know that the business is applying consistent reporting techniques so that there isn't variability in the information because they've done something differently. That's kind of a little bit duplicitous. If they did their accounting reporting one way one time and a different way another time, that would not necessarily be a fair representation. You wouldn't know whether things were the same or different because they were reporting it differently. So we want to use what we call a fiscal period. It's the length of time for which a business uses to summarize the financial information that they're reporting. So, for instance, some businesses, they report their fiscal year ends at the end of the calendar year, December 31st. Some businesses use a fiscal year end of June 30th. Some use September 30th. It all depends on your business. Typically speaking, a company uses picks a fiscal year end shortly after their busiest season, typically, because the logic is that they want to, if they have any types of inventory or supplies or anything like that, right after their busy time, theoretically, all of that stuff is cleared out. So they have the least amount of that stuff that they should have on hand at the end of their fiscal period. So company, and typically companies in certain industries have similar types of fiscal year ends. So for instance, you have companies as we go into the holiday season, retail companies, Macy's, I don't know who else, Macy's, Abercrombie, Target, all these types of retail companies, Walmart. These retail companies are really stockpiling their inventory right now. Okay, in anticipation of this busy season that's coming up. Well, come January, what do you see going on in those stores? What's going on? Sales, right? They're trying to get rid of everything. Everything that they didn't sell during the holiday season, they're looking to get rid of come January. So what they do is they put it on sale, and typically speaking, a lot of retailers have a fiscal year end that's like January 31st because they want to have everything gone by the end of their fiscal period. So when their fiscal year ends, they have the lowest inventories possible because, typically speaking, these companies have to physically count all the items in their inventory. So think about that. You walk into Target, you walk into Dick's Sporting Goods store, think about having to physically count all of that stuff. Does anybody work in any sort of retail business? Does anybody work? Okay. Well, do you have to count it? Where do you work? Where do you work?
Pretty personal gifts.
Pretty personal gifts. Yeah, you have to count it all. Summit? Best Buy? Oh, yeah, that really stinks. Right? Okay, so think about that. In Best Buy, now you have to count all those little disk drives and all those little wires that they sell and all the computers and all the stuff in the back, everything, right? I had somebody that worked in the movie theater in Crossgates Mall one year, and they literally did a physical count every single week. They had to because they had such volume and turnover. They did a lot of inventory, counting. Okay, so every business will have an accounting period that's specific to itself. Yes.
We know what we have, and then we have a running list. So whenever we get new supplies in, we add it to our inventory list, and whenever we sell something, we take it off. So we always know what our inventory.
Yes, you will, but businesses do a physical inventory to confirm that what their computer says is what they actually have on hand. To do a verification, make sure there wasn't any damage, there wasn't any stolen merchandise during the year, things like that. So, yes, that's true. Okay, accounting period concept. This is, we apply this concept when, with regard to our fiscal financial reports and the like, to make sure that we're using this consistent reporting throughout our accounting year, our fiscal year. So a company has what we call this accounting period concept, and our accounting periods are typically quarterly, monthly, semi-annual, and annual. Okay, and they typically report their financial information for each one of these fiscal periods, like whether it's for a month or a half a year or whatever. Yes?
When I was working in Scotia this summer, back when I first started working, it was the end of one of the quarters, and the whole accounting section of the business, they were just freaking out. Like,
right.
Everybody was on their back.
Right.
Crazy.
Right. Yeah, typically your accounts have like some really busy periods, and the end of their fiscal periods are usually pretty crazy busy. Like, for instance, our guy, remember he said that yesterday when we were there, he was kind of saying we're good to go for a little while. We're not going to be that crazy busy because they just finished an accounting. I think it was one of their quarters, okay? So they won't be that crazy busy for a little bit longer. Okay, and then financial information is always summarized at the end of the fiscal period, meaning the 12-month period, no matter what. So, like, not necessarily every business publishes all these financial reports every month or quarter, but they definitely do every year. But if you're a publicly traded company, publicly traded companies are required by law to report quarterly, semi-annually, and annually. Okay, good to go? Okay. So, a worksheet, as you guys have already learned, it's a columnar accounting form that is used to summarize the information that's in the general ledger. So, if you guys could, because this is going to start to get confusing, could you make sure you put your computers down, close those cases for a minute for me, because I want to make sure that we're really getting all of this stuff as it starts to get a little bit more confusing. So we're going to take all the information that's in those ledger balances, and we're going to put it into this worksheet to help us summarize it, and we're going to do the 4 things that we discussed in our accounting log. We're going to prove, first of all, that our debits equal our credits. If your debits don't equal your credits, that's an immediate red flag. That means you have to go back and figure out where the problem is. Okay, you can't have your debits not equal your credits in your trial balance columns of your worksheet. You will also use your worksheet to plan any types of adjustments. As I mentioned, you could have your accounts be a little bit out of sync with what reality is. Like, Maddie was just saying that they have their inventory records on the computer. So every time they update and buy stuff, they update their computer system, and then every time they sell, they update their computer system to reflect that it's sold. Well, the problem is that that's not taking into consideration if anything might have gotten stolen or damaged, broken, somebody returned something, etc. So now you've got to make sure you do adjustments to account for that. And we'll learn about that in this chapter. And then number 3, we're going to separate our ledger balances for the different types of accounts into the proper financial statement report that they're going to be used in. So now we're going to learn about where do we get that information that goes into our balance sheet, where do we get that information that goes into our income statement. And then lastly, we're going to use that information on the worksheet to help us calculate our net income or loss for the given fiscal period. All right. So, pause. All right. So we're going to start looking at the worksheet. So what I would like for you guys to do is in your textbooks, you guys have noticed that you have those kind of funky, like plasticky kind of pages in your textbook, yes? Okay, we're going to start learning how to use those funny plasticky sort of pages. So just turn to those pages for the moment, if you will. Don't do anything. Just turn there. You could share a book between the two of you if there's a lot of stuff going on your desk. Take your computers, put them to the side, and share a book between you and your bud, and do it that way because it's kind of a little busy. All right. So just put them, if you will, for the moment. Just put them. Just put them like this. So the first page and the plastic pages are down. First page up, like this. And then the plastic page is down. And just stick it in the middle of the two ears like that, okay? All right, good. All right, so let's go. First thing we're going to do, like any other of our financial statement reports, we're going to start with a heading. Our heading is always going to include 3 lines. So you'll look on that page and you'll notice that there's a heading at the top of that form. The heading is the name of the company, right? Techno Consulting. What this form is, it's called the worksheet. And then what's the period of this form? You will notice that this is telling me what is the period that I'm dealing with. Okay? Not a date in time, but a period. And this is for the month ended August 31st, 2016. Okay? That's important to know because how long are we accounting for in this report? 1 month. It's not a year, it's not a quarter, it's 1 month. That's important to know. So we have name of the report, date, moving on. Then the first 2 columns, if you look at the first 2 columns on that report, what does it say on the top? Top of that report, it says what? It says trial balance. Okay? Very important. The trial balance is primarily the reason you have the trial balance is to prove your debits equal your credits. That's our trial balance. Okay? We have all of the accounts in our ledger go into the trial balance even if we don't have a balance in them at that point in time. You put all of them in there, okay? So like for instance, down here, down at the bottom, you notice under the expenses, you don't have any balance in your insurance expense, you don't have any balance in your supplies expense, you don't have any balance in your income summary account. That's fine, you still include them. And you include them in that order that is in the ledger, which should be the same order as your chart of accounts, which should be the same order as assets, liabilities, owner's capital section. Then we have our revenues, and then we have our expenses. Yes, Kira?
Still indent credits?
No, you don't indent. All the titles go on the left margin. You put the debit balances in the debit column. You put the credit balances in the credit column. Okay, and that's how you're going to go about approving your debits equal your credit. So you're going to literally take this information from that ledger. So right now, if you were to pull out your Candy Co. Candy Co. company ledger, you only have 2 accounts in that ledger, okay? But you would put all of those accounts, assets are in liquidity order, so what should be first always?
Cash.
What comes after cash? Good, petty cash. What comes after petty cash? Right, and if you had more than one account receivable, it would be alphabetical, okay? What comes after accounts receivable? What comes after supplies? Prepaids, right? Any prepaids. And then what comes after prepaids? Your liabilities. What order your liabilities? They're the accounts payable, but how quickly they're going to be paid off. If you had multiple different, you'd put them in the order of how, like if you had mortgages payable and accounts payable. Mortgages are going to take longer to pay off, so you'd put the accounts payable first. Yeah, I will have you always do it alphabetically. I'm not quite sure why they did it this way. That doesn't follow the rule, but maybe Campus Internet has a longer term contract with them for payment. Maybe they have to pay in 60 days instead of 30 days. That does happen. Some of your accounts receivable negotiate terms and they have 60-day terms instead of 30-day terms. But it should be like you're saying. Okay? Same thing with your accounts payable. Then you have your capital. It's always going to be you're going to have your equity, and it's always going to be capital. Then during the income summary, and then your sales, and then your expenses are going to be in alphabetical order. Okay? All right. So, my bad. We're going to stop there for a minute. Don't go on to this slide. We're going to stop, and we're going to do the work together for 6-1.